Hi, welcome back. I'm Justin Zaks, Vice President of Strategy at Moomoo Technologies. Welcome to the last webinar of the day. If you missed our first webinar with Wellington's Francisco Mayano on investment ideas for 2025, or the second one, advantages of ETF portfolios in the current financial market with Matt Camuso from BNY, replay in the app will be available shortly. This is the first day of our inaugural 3-day virtual event entitled Navigate Market Volatility with a Resilient Portfolio. There's a lot of uncertainty out there right now, and we put together a diverse program to help steer your portfolio in the right direction. Each day, we're going to have 3 webinars, approximately 40 minutes in length, with a 10-minute break in between each of those. And so for tomorrow's webinar on Friday, it's going to start at 1 p.m. Eastern, and Saturday's webinars will start at 10 a.m. Eastern. This is an event that's going to give you an opportunity to learn about a bunch of different topics, including zero DTE options, ETFs, portfolio building, earnings season, U.S. elections, and how to use the Moomoo app. We're going to be talking to a number of experts from many of our valued partners, including Cboe, Wellington Management, BNY, and Franklin Templeton, as well as a bunch of experts in other financial fields. Our third webinar of the day is Managing Volatile Markets with Zero DTE with guest Ed Tom, Senior Director, Derivatives Market Intelligence at Cboe Global Markets. We've done a number of educational webinars with Cboe about options, so please check them out on YouTube or the Moomoo app if you like this one. Ed's going to talk to us about different types of high-impact intraday events and the zero DTE option strategies that can be used around them. In the first half of the presentation, Ed is going to deliver a slideshow where he's going to teach you how to trade around economic releases, earnings releases, FOMC meetings, even surprise events. In the second half of the webinar, we're going to have a Q&A. So please enter your questions in the chat for Ed right now, and make sure to watch the entire webinar. We'll try to get to as many questions as we can in the time allotted. If you do enjoy this webinar, please check out the live section of the app under the Discover Moo tab to sign up and set reminders for many of our more informative upcoming webinars. Let's get started right away. Welcome, Ed.
So one of the most popular products to take advantage of high volatility environments is obviously a zero DTE. So what I thought I would do is, give some background as to how zero DTE trading strategies are constructed and the optimal cases for usage. So the plan I have for today is we're going to discuss some trading catalysts, discuss how to structure the trades, taking advantage of understanding the Greek dynamics and how to monetize the trade, and then do like a very simple case study using the FOMC. Okay. So just to start off with, the zero DTEs we're not really a product in and of themselves. They're basically an extension of existing S&P contracts that basically have decayed to 1 day of expiry. And because Cboe basically offers S&P options every day, like there's always at least one option that is available that expires with 1 day left to expiry. Okay. And at this point, we've seen a huge growth in zero DTE options over the last few years. So at this point, about 40% to 50% of all S&P options traded are zero DTE options. So very quickly, one of the keys to successful implementation of zero DTE is discussing the timing. When do you put on the trades? And then once you've decided that, like, how do you go about positioning the trade? How do you structure the trade? And then finally, just as important as the timing of when to place the trades, importantly is how do you unwind the trade? When do you unwind the trade, and at what point do you monetize? So the ideal types of catalysts to use zero DTE are situations in which over the course of 1 day we have a very high level of volatility. So basically, what that generally indicates is a situation in which there's some type of dislocation. So we basically categorize the dislocations into three buckets. One is a periodic dislocation, where we know for a fact that this event will occur. So an example would be, let's say, FOMC announcement or economic release, such as non-farm payrolls. The second type of catalyst would be opportunistic, ones in which the markets really don't expect. And usually they're announced on the day of the action. So an example would be a market intervention or a geopolitical event that occurs, or some type of disaster. And finally, the third type of category would be to use intraday market alpha strategies, whether it be some type of like price trend or reversal strategy, taking advantage of the value risk premium, such. So what I have over here is basically like a table where we show like the economic releases that causes the largest intraday moves. So basically these are the situations in which we have the highest dislocations for usage of zero DTE. So I categorize over here the economic releases into pre-open and post-open. And the reason why is because the type of positioning that one uses for pre-opening is a little bit different than post-opening. In some cases, for pre-opening economic releases, there are cases where you might want to, let's say, take a position the day before versus actually just using zero TE and initiating the position on the day of. Sorry. Um, So this basically over here, it gives a brief overview of the type of structures that is prevalent amongst the zero TE space. You can see that, like, for the most part, the types of usage for zero TE is fairly evenly distributed amongst the 8 different strategies. And the way to think about like how to construct a trading strategy is that there are like basically two aspects. One is what is your directional view, and the second one is like what is the extent of the move that you expect. Um, so so the combination of those two answers basically provides the trading structure. Now the type of terminology that we use in the options space is delta. The way to think about it is that a 50 delta option, for example, is means that you're basically like trading an option that has a range of one standard deviation move, right? And a one standard deviation move in the markets is considered to be fair. That's exactly what the option markets are currently pricing in. So in order to really monetize any type of options position, one has to either express a view where you believe that the underlying will move in excess of one standard deviation, or you believe that the option will move less than one standard deviation, basically like either more or less than what the option market expects. So as an example, like if one wanted to buy, let's say, one wanted to take a position that a particular underlying will increase a lot, one would buy, let's say, a 10 delta call option, which basically means that you're taking the view that the option will monetize if the underlying moves in excess of 2 standard deviations. Okay. Um, there are some idiosyncrasies of trading zero TTE that's a little bit different than a normal like longer dated option. I'm going to discuss three components. One is the volatility level that's used to reference zero TTE. The second one is the minus, and the third one is the Greek dynamics. And in particular, we're going to discuss how the gamma and theta behave differently for zero TTE versus a regular longer dated option. So the one thing to kind of like understand about DTE options is that that um, the the implied volatility greatly accelerates going into the close. So this is basically like a chart of the average implied volatility for zero DTE option over the course of one day, and you can see that for the most part, from the 9:30 open until around 2 o'clock, the implied volatility levels for any given zero GTE is fairly stable. But then after around 2 o'clock, then it starts to really escalate into the close. And finally, in the last half hour trading, you see this humongous surge in implied volatility. Sorry. Um, So the one aspect about training choosing the strike level and the moneyness of DTE versus a longer dated option is that obviously the strike range for zero DTE is greatly compressed. Over here, what we have is an example of basically a conversion of delta from a longer dated option into zero DTE terms. So as a reference point, a 1 month 30 delta call at 15 VIX is generally about 2.5% out of the money, right? But a 30 delta zero DT option at 15 VIX is about 30 basis points out of the money. One really needs to consider that in trading ZGTE, the strike range for monetization is greatly compressed relative to that of a longer dated option. Now, with respect to the Greeks, you see basically the same pattern for the um, how theta and gamma progresses over the course of the day, as we saw for implied volatility. So both theta and gamma greatly accelerate into the close, and really around the same time that we saw for implied volatilities. So around that 2 o'clock mark for theta, you start seeing like basically accelerated decay of the option, and for gamma, you see basically like a height and acceleration after 2 o'clock, right? So this is basically just example where we actually use particular events to kind of like showcase that decay. Over here we kind of like overlay FOMC announcement days versus days which we have like really like no major catalyst, and you can see that on FOMC days you see a much greater decay profile heading into the close. So the way that we kind of segment the types of dislocation over the course of the day is into three parts. The first one is positioning for a known midday catalyst, such as OMC. The second one is positioning for a known pre-open catalyst, such as most economic releases, such as payrolls, right? And the third one is more opportunistic, where we position for a new catalyst that occurs at the open. An example is the August 5th yen carry unwind. So I'm not going to go through like all three examples. I'm just going to focus in on FOMC as a case study. So, the one thing to know about FOMC is that it's On FOMC days, the markets are very stable up until 2 o'clock, right? Here are just like four snapshots of different FOMC meetings over the course of the last 3 years, right? And you can see like it has a very similar pattern trading profile where up until 2 o'clock, it pretty much range trades over a very short time uh, price range, and then after FOMC at 2 o'clock, you see like very large market moves, either to the upside or downside. So FOMC announcements can have intraday swings of up to 6.5%, right? And this is the perfect usage case for a zero DTE type product. Okay. So over here, we just basically just kind of like reinforce that point where we contrast the volume activity of trading zero GTE versus on FOMC days versus non-FOMC days. So on the left-hand side, we have a typical like non-FOMC days, and you see like a volume model that's very consistent with ones that you see like pretty much across any equities asset class where you have a great deal of volume both at open and close and not as much volume as we head into midday. Whereas on the right side, we observe the trading pattern for FOMC for zero DTEs, and you can see that there's much diminished volume activity going into 2 o'clock, but then after 2 o'clock, you see basically a doubling of trading volume when the dislocation is the highest. So we've run a number of different strategies to try and discern like, okay, what type of strategies are most effective using zero TTE on FOMC. And basically like the profile that has seen the most success is one where you basically like sell volatility up until 2 o'clock and use the proceeds from that to fund your long position after 2 o'clock. So the idea is to basically like to create a funding pattern to to buy premium for or upside convexity which will enhance performance after the 2 o'clock announcement. And the type of P&L that we see is if one were to kind of like follow that type of trading strategy, you would basically see on average about a 2.5 time increase in P&L. So basically, this is just a summary of everything that we discussed. Zero DTEs are designed to monetize high impact intraday events. The type of strategies that are required to use zero DTE depending upon when the catalyst is meant to occur. So we divide into like three parts: a pre-scheduled midday catalyst, a pre-scheduled catalyst prior to the open, and a surprise catalyst that occurs prior to the open. For FOMC and other pre-scheduled midday events, a winning strategy is to fund the long trade by selling volatility prior to the scheduled time, and then going long after the 2 o'clock announcement. For in the money zero DTE positions in high volatility regimes, the the positions should be monetized quickly to avoid theta burn. And basically, like we saw, of course, that theta decay occur after 2-3 o'clock, right? And pre-scheduled catalysts such as economic releases require a hefty move to kind of overcome that excess theta decay of holding a long position overnight versus buying the open. And that's it, Justin. So at this point, if you have any questions or the audience has any questions, I would be happy to field them.
Thank you so much for that. It was very informative. I want to get straight into some of these questions. We got a lot of great questions from our audience. The first thing I want to really talk to you about is the timing of these zero DTE trades. A lot of people, when they're doing trades, they're looking for a certain gain or they're going to stop themselves out with a certain monetary loss. So they're looking for a gain or loss. But here with zero DTE, it's just, you have this time decay, this theta component. How do you work that into the equation when you're dealing with zero DTE?
So it really depends on whether you're long or short. If you're basically like trying to harvest the VRP, basically just trying to capture the volatility risk premium, then actually the theta decay actually works in your favor, right? So in that case, you probably want to hold till the end of the day. But in cases where you're long, basically you have to have good sense for what point is the catalyst basically going to level out. And so whenever that is, you basically want to monetize intraday as quickly as possible to kind of like avoid that the P&L kind of melting away.
Yeah, so that's a good advice for a lot of people. I think a lot of people sometimes are a little too hesitant to take their profits, and with zero DTE, you could run into trouble just on the time decay, even if it goes the underlying continues to go your way. So that's something to be aware of when you do have that nice gain. It might be an opportunity to monetize and get out of that position. And so what I really thought I want to talk about is the U.S. election and just probably have 5 different questions related to how this all works because it's such a unique event. You talked a lot about these surprise events, and then you talked a lot about these scheduled events. And here we really have an event that's kind of both. We know the election is going to happen. We know there will be a result. We don't know exactly when that result will be apparent, or that it may become apparent in stages. So kind of my first kind of question was, what type of strategy, what happened in this U.S. election in terms of the volatility? The first thing maybe I'd ask you is, the day of the election volatility versus that overnight going into the next day. You saw a quite different volatility, implied volatility. Is that correct?
Yeah, that's right. Yeah, so we basically saw like a 15-point premium between November 6th, the day after elections, versus November 5th. That's huge. So kind of put things in context. So ordinarily, like for U.S. presidential elections, we normally see like a 1.5 to at most 3-point vol premium from November 6th to November 6th. So basically the day after versus the day of. In this case, the amount of volatility premium that we saw was 5 times that of an ordinary election, right? And basically what that meant is that option volatility trades were pricing in essentially like a huge overnight gap risk. So basically the amount of overnight gap that was being priced into options was basically like a 1% move overnight. And over the course of that one trading day on November 6th, they were basically pricing in a 1.5% move, right? For a total of about 2.5%. And interestingly, like the option pricing for November 6th was actually pretty spot on. So it was very consistent with what actually occurred as far as S&P moves.
So that's very interesting in of itself. And so that's kind of my next question is like, what strategies actually worked for this in regarding the zero TTE? I mean, were the vol sellers making money or the vol buyers, or what strategies seemed to work better, spreads or?
Yeah, so we ran about 10 different strategies, and the one that really stood out was synthetic long. So basically, like going long at the money call by funding it by selling at the money put. So basically, like a risk reversal, if you will, right? But the second strategy that performed very well was buying very low delta calls. So basically, like by buying very cheap out of the money call options, because the move was so large that by having many units of those many low delta options, as the markets moved up about 2.5%, a lot of those deep out of the money calls basically moved in the money. The amount of P&L that one were to realize by buying low delta calls is sorry, about 10 delta calls. It's about 60x. So very significant.
Wow. And that's something I want to get a little bit more into, and I'm very curious as to what the skew profile was going into the election. And maybe for our more beginner viewers here, you could define what skew is, and let me know if we would have had a similar move to the downside, would investors have made as much money in 10 delta puts, for instance?
Yeah, so basically, I think a very quick way to kind of like describe skew is the relative demand for puts versus calls, right? So basically, like skew becomes elevated when there's a huge demand for puts, and what happens is that because puts are normally expensive, uh, you know, portfolio managers generally fund that by selling calls. So the pattern that you see, like going into an environment where there's a lot of concern, is a lift in the put side part of the skew and a depression in the call side part of the skew, right? So um, for basically since August 5th, the markets have seen extremely highly elevated levels of skew, meaning that the volatility traders were pricing in a huge premium for put options, and the pricing basically like a very low level for call options. So going into elections, what that basically meant was that if the markets were to shock down like 3%, you wouldn't really see much of a reaction in the vol front because traders are already pricing in an elevated level of volatility in excess of what they normally would charge, right? And conversely, for a large move to upside, we basically saw like much lower depressed levels of let's say VIX uh, priced into the surface than what would normally be expected. So what happened on elections was that for elections week, we basically saw like a 4.5% increase in S&P over the course of 3 days from November 5th to November 8th. And what happened was the VIX declined 7 points. Interestingly, that was completely priced in by the skew. So even though like a 7 point decline in VIX is a large number, like that was totally taken into account by the volatility traders.
Yeah, and on that question, I just want to, maybe you could just go into that a little bit, more in depth. We had almost a 5% move over a few days in the market to the upside, yet the VIX crashed, and just generally implied volatilities across the markets came down significantly. How does that also factor into the actual realized volatility that you have? I mean, at what point, and particularly this is a question we see a lot, particularly for zero DTE, because the realized volatility matters at some point, right? Like from your when the actual instrument expires, it will have moved a certain amount during that day.
Yeah, of course. Yeah. So basically, there's actually like a pretty tight relationship between implied volatility and realized volatility. So the kind of like really broad way to think about implied volatility is that it's comprised of three components. So the first and large component is the volatility of the markets due to economic fundamentals. And that constitutes about 80% of what implied volatility is. And a proxy for the volatility of the market due to economic fundamentals is realized volatility. Okay. And then you layer on top of that two other things. The second thing is the premium due to the demand on behalf of portfolio managers for downside puts, which we call skew. And finally, the third component is the additional demand that volatility traders charge for tail risks, which we consider to be kurtosis. So the sum of those three components is basically what makes up implied volatility. So if realized volatility were to spike, implied volatility would, of course, follow suit, and vice
Yeah, that's a
versa.
great explanation. And a lot of people are also very interested in, these implied volatility spikes during, during the day. Normally if you have a normal day, the options will decay as you go along, in a certain fashion. But if we do have a surprise event, we see these implied volatilities move up and the price of the options gets more expensive even as the day goes on. How quickly is are these types of news events priced into implied volatility? Are you talking microseconds or a half hour? How long does it usually take?
It depends on the underlying. But basically for the S&P, which basically like is basically the universal hedge for not only globally but across asset classes, right? So basically, like if there's panic anywhere in the world or in any asset class, um, because the S&P options complex is really the most liquid of any asset, like traders portfolio managers will go to the S&P and take positions accordingly. So for S&P, it's microseconds. For less liquid underlines, then the duration could be much longer.
Right. And we saw what you were talking about back in August in Japan. We really had news out of Japan, and it was more of a Japanese issue, but we did see some volatility shifts in zero DTE and short dated options in SPX, right? Can you talk a little bit about what happened then?
Yeah, so actually that's a perfect example where where you have a catalyst that occurs like in Japan, like it's basically the Nikkei dropped like 12.5%, right? So um, So what managers all over the world do is they gravitate toward S&P options. Due to the demand for S&P options, basically like you see an increase in implied volatility and therefore an increase in the VIX.
That's very informative. The other part I think a lot of people are very interested in is around these economic numbers. All I ever hear about is the payrolls numbers and how important it is. And meanwhile, a lot of people talk about how these payroll numbers are very unpredictable. Yet it just seems to be the one number a lot of traders gravitate towards. How do you know if the implied volatility is priced correctly? Going in, what type of analysis can people try to figure out, well, this is just historical, or any other types of things that they can figure out when they're going in and they want to know, is implied volatility, too pricey or not pricey enough for particular economic events?
Yeah, so that's a really good question. So basically, like, so but- so back in the old days, volatility traders used to basically have like macroeconomic factor models to kind of like try to predict volatility, and initially, like, they were focused on the actual level of the report themselves, right? So the actual payrolls number, right? But what they would kind of realize later on was that like what mattered was not so much the levels, but the surprise, right? So basically, like the current models that volatility traders use is based off of like the expectations of surprise, uh, and any type of surprise is basically quantified by basically using some type of distribution, usually like a normal distribution, right? Which coincides very well with like how volatility is traded, because volatility in itself basically is a description of a normal distribution. So basically, like you know the idea of like whether volatility is currently rich or cheap is basically measured against the the distribution for the amount of surprise that you have um, going into like a payrolls number or any other type of like economic release.
Yeah, that's a very, and probably I could spend another 10 minutes or 20 minutes talking to you about this topic. I would love to understand, because we sometimes these aren't normally distributed, and we're seeing these 7 standard deviation moves, and you have clumping among economic expectations. We saw this with the recent payrolls number. We saw a huge miss, but a muted reaction in markets due to the idea that there's a whisper number and all these other things. It's a very fascinating topic, but I do, in the interest of time, I want to move on to some of these other questions. The other part I'm really interested in that I don't think people talk enough about is that last hour of trading. So you talked about, pretty much this kind of linear decay during the regular day, but then the profile's out the window the last hour. So maybe you could, tell us a little bit more about how volatility behaves, how the market behaves in the last hour, and why it's different, and what type of strategies you might want to use, and how risky it can be.
Yeah, so like the end of day trading is very complicated because there are many type of strategies and vehicles that focus the trading on the end of the day. So, for example, let's say like levered ETFs, right? So levered ETFs oftentimes are hedged within the last hour of trading, and basically like uh, those positions are levered, oftentimes like the amount of trading that needs to be done in order to like hedge those positions is as many multiples of what you would normally see over the course of that day, right? And then you've got program trades, vol targeting trades, end of day close trades that all occur like near the last half hour. So like it's a confluence of a lot of different strategies focused on that last half hour trading that causes basically like a high vol into the close.
Great explanation. And another question we get a lot is about the volatility term structure. This idea, normally we see the closer you are to expiration, the lower volatility is, and then as you go out several months, volatility tends to be a little bit higher for overall overall implied volatility. How does that work for zero DTE? 2-day, 3-day, just stuff that's within a week. Is it very flat, or is there some type of slope to that, or is zero DTE more expensive often?
Yeah, so that's a really good question because I would say that at a very superficial level, yes, the term structure for short dated options is upward sloping, right? But if you were to kind of zoom in, let's say on 1 week's worth of trading, what you would really see is like a more like ragged pattern. Like it almost looks like a jigsaw pattern, like that tends to be like upward sloping ish. But it would look a little spiky. And those spikes kind of reflect interest uh, in options positions for very specific like 1 day events, whether it be like earnings events or economic release, right? Where there might be like a demand for optionality on one particular day and less for the surrounding days.
Yeah, and that's a very good point, in something to remind our users about is, when you go in there and you're trading a zero DTE options, the prices can be wildly different from day to day. From a Tuesday to a Thursday, you might see, like you said, you could see double, you could see much different pricing depending on if there's going to be some type of expected event coming up that people want to hedge out for. So, Ed, it was been a fascinating conversation we've had today. I'm sure we could talk a lot longer, but we do have a limited amount of time. Do you have any last thoughts from our audience about zero DT strategies?
No, I think we kind of like covered like the essential points, right? Obviously, like there's a lot more detail behind this one presentation, right? But I'm very happy to like field questions, from the audience on either more detail or more about specific events.
Yeah, we'd love to have you back on, and we will get some of those questions. Please, if you do have any questions, please put them up in the chat, and we'll try to answer as many as possible. A few of you asked about the replay. This is certainly a complex topic, and we will have this available for replay in the app shortly after the live stream ends, so you can kind of watch it and pause it and maybe rewind it. And the Cboe and Mumu are great resources for education on topics related not only to zero DTE, but all options and other types of of instruments that are used in the market. So go into the the Learn section on the Moomoo app. Check out the Cboe website. And Cboe has these great resources that include people like Ed that have been doing this a really long time and really know their stuff. Ed, again, thank you so much, and thanks to everyone for tuning in. Make sure to check out the special offers on our website if you're not already a Moomoo user. I'm going to be back tomorrow, Friday, starting at 1 p.m. Eastern with 3 brand new webinars. How does a professional fund manager build a portfolio? We're going to have 3 fund managers that have been fund managers for decades each, giving us their professional opinion on how they go about building portfolios. It's a really great insight into how the pros do it. So if you want to be able to say, I want to learn how to build my portfolio, we're going to give you a great opportunity to do that. That's the first one. The second one is going to be an analysis of this recent earnings season. And the idea, and talking a little bit about the growth versus value. We've seen a really interesting earnings season, lots of great, interesting results, and lots of ups and downs in individual stocks. And that's going to be with our partner, Franklin Templeton. And then finally, the third webinar is going to be about, again, with Cboe, we commissioned a survey in the third quarter where we use Cboe's data to support us. And we're going to be talking to some people at Cboe about the results of that survey and really teach everyone how our users are trading options and then what's going on in the overall market with us with that Cboe data. Until then, happy trading to you all.
Worried a stock's price will go down right after you buy it? With Moomoo, you can check out the most updated short sale analysis before you trade. Find out how much a stock is being shorted and its short sale trend. Get a clearer understanding of the market and trade with greater confidence. Short sale analysis is free and exclusive on Moomoo. Download Moomoo now.
Too much research, too little time? What if you move smart? Invest smarter with Moomoo. Small gains, big efforts. What if you move smart? Invest smarter with Moomoo.
Everyone around me is talking about investing. Do you invest too?
Moomoo.
There's so much research to do, but so little time.
Moomoo.
But how do I actually start?
Download Moomoo.
Investing made easier. Download Moomoo now.
Moomoo has partnered with derivatives world leader Cboe, bringing you an options experience like never before. 5 major index options are now available to trade on Moomoo. Enjoy competitive pricing with zero commission, as well as zero contract fees for stock options. Inform your strategies with Moomoo's suite of free options features, including as many as 13 option strategies for you to choose, with their theoretical profit and loss analysis quickly revealed, as well as in-depth options chain, among many others. Experience pro-level tools by downloading Moomoo now.
Hello, Japan.
Hindsight sucks. It's all about foresight. When it comes to trading, you gotta get your calls right. Moomoo's the platform with AI intelligence, serving up insights based on customized relevance. Globally backed around the clock support. Pro-level features at a cost of naught. So let me ask you some questions that may seem curly. Would you rather work from dawn or retire early? Dream of getting on the ladder or buy a dream home, dance to someone else's tune? Or Moomoo your own?
Worried a stock's price will go down right after you buy it? With Moomoo, you can check out the most updated short sale analysis before you trade. Find out how much a stock is being shorted and its short sale trend. Get a clearer understanding of the market and trade with greater confidence. Short sale analysis is free and exclusive on Moomoo. Download Moomoo now.
Too much research, too little time? What if you move smart? Invest smarter with Moomoo. Small gains, big efforts. What if you move smart? Invest smarter with Moomoo.
Everyone around me is talking about investing. Do you invest too?
Moo.
There's so much research to do, but so little time.
Moo.
But how do I actually start?
Download Moo.
Investing made easier. Download Moo now.
Moomoo has partnered with derivatives world leader Cboe, bringing you an options experience like never before. 5 major index options are now available to trade on Moomoo. Enjoy competitive pricing with zero commission, as well as zero contract fees for stock options. Inform your strategies with Moomoo's suite of free options features, including as many as 13 option strategies for you to choose, with their theoretical profit and loss analysis quickly revealed, as well as in-depth options chain, among many others. Experience pro-level tools by downloading Moomoo now.
Hello, Japan.
Hindsight sucks. It's all about foresight. When it comes to trading, you gotta get your calls right. Moomoo's the platform with AI intelligence, serving up insights based on customized relevance. Globally backed round-the-clock support. Pro-level features at a cost of naught. So let me ask you some questions that may seem curly. Would you rather work from dawn or retire early? Dream of getting on the ladder or buy a dream home dance to someone else's tune? Or Moomoo your own?